Okay. Okay, this is the first book of the month club. I'm sure, like a lot of us, we've read a lot of trading books. I know I've probably read over 100 of them. And this book we're going to talk about today is Best Loser Wins by Tom Houghton. London Dale had made a concerted effort, a really diligent effort in trying to get Tom to join us for this meeting. And we weren't able to get a confirmation that he could join us. But we thought we'd go ahead and discuss it and, kick it around. And if at some later point we get a confirmation from Tom Houghton that he has some time for us, then we'll schedule that, put it out there, and anybody that wants to attend and let him present to us and ask us any, and maybe be open to questions from us. We'll let everybody know about that too. So hopefully that comes to pass, but in any event, we'll press on. So I'm just kind of open this up. This is a book club, so that means everybody gets to talk. And I thought we'd just kind of open it up and ask, what y'all get from the book? What y'all like about it? What were your key takeaways? And are there any topics or questions that you would like to hear discussed today? And I don't think I'm gonna go around the room and call on everybody, but I will if that's what it takes. So hopefully everybody just kind of starts chiming in. Please.
Yeah, I'll jump in here. So it's actually funny. Prior to everybody coming in, I told you I didn't read the book. I didn't realize that the book was Best Loser Wins. That happened to just be a freak coincidence. I think I started reading that one a little bit before this whole book club started. So I actually did read it in the last month.
No.
So as you and I were just talking about, the trading psychology aspect was really what made an impact on me. I've been doing a lot of trading stuff, probably last 7 or so years, really diving into it, learning absolutely everything I can, from day trading to position trading. And I was one of those people that had the mindset that strategy was more important than mindset. I think I understood, obviously, that I have to be able to take a loss. I think I always understood that I had to be able to take a loss. I kind of understood that your winners need to be bigger than your losers, that general psychology, but I never realized how much went into it. So I don't know, just kind of that shift in mindset was what really spoke to me in his book. And it definitely kind of sent me down a different path than I've been on. So that was cool.
Well, thanks. Just some of my takeaways were that normal thinking doesn't lead to profitable trading. And so when the key message is if you think like most people think, you're going to get the same result most people get, and most people lose money trading. So, so how do the small percentage of winning traders think? And I think he does a good job of talking about that in the context of momentum trading. But we have a little bit different style of trading in this room. And so how does, one of the questions I'd like to see talked about is, how does a winning option trader think? And how is that different from, the way losing option traders think? So that whole area of mindset is really interesting to me, because like a lot of times, just like you talked about on taking losses in option trading, a lot of times we're encouraged to roll and not take a loss, to hold on to the losers rather than take the loss. So there are some differences here between this type of trading, even though I think his whole mindset approach is excellent.
Morning, everyone. This is Candy Recker. And thank you, Trey, for putting this together and leading it this morning. I'll give you my take of when I read the book, how it changed my trading as an option trader.
Cool.
I finished my mentorship with Bobby and launched into this book. And so I basically I tried to combine the best of both worlds. I could never understand why people would have losing trades in their accounts and not have the ability to manage them. Once he explained it, it was a lot easier of how we as people want to avoid the pain of what that causes. So what I did was use the areas of the book where people failed, and I tried to turn those into rules and structures that I use to manage my accounts. So one of the immediate things that I picked up on was that continuous systems have the highest risk. I had to accept that. I was trading a process and a trade that I had to stay on top of all the time. Secondly, hedging can create a false sense of security, and that I needed to realize that I could not just rely on that to manage my capital. And so I went about changing the structure of my trades. I added other trades. I took the risk down. I knew what I could do well in a all-out crash situation to manage my capital. And I'm really happy with the things that I've implemented, because I realize I'm the only one that can protect my capital. And if that means I have to close trades and use stop losses to protect it, I will do that. And so I'm prepared with my rules. I stress test my rules, that just because a rule is in my trading plan doesn't really make it so until I can operate that rule effectively and easily and know what the outcome will be in advance. So it gave me a lot to think about and a lot of proactive things that I've changed and implemented. And I'm very thankful for having read the book.
Cool. That's awesome. Thank you. Yeah, he talks about trust and being able to trust yourself to do what you're, stay with your process and do what your plan says. I thought that was a good piece of the book for me too. Who else? What else did y'all get from it? What did y'all like about it?
Hey everybody, hi Trey. This is Bill Thornton. Thanks for doing this, but my take on it was I learned that I have to be better at monitoring the winners and watching winners. I don't have a problem putting trades on, and I don't have a problem taking them off if they're at a loser. I do have a problem in when it goes green, I get nervous and I don't want to lose it. And that's the main thing I got, is that you just have to ignore all these emotions. That's far easier said than it is done. But that's what I mainly got out of it, that you have to have a mindset and you have to be oblivious to all emotions. But as I say, it's way more difficult to do than it is to read about. So that's my little contribution anyway. That's what I found.
Cool. Thanks, Bill. Yeah, I have those same feelings. I thought the part on risk reward that in the book was really interesting. He talked about that, people would ask him in his trading room, well, what's your target for this? And he says, and he would have some kind of snarky reply, but it was based on the idea that his type of trading, he didn't have a target. He wanted to let it run as far as they can. That's one of the distinctions I found between momentum trading, his type of trading, and our type of option trading. We do have targets. We have often we have maximum profits and unlimited losses, when on these naked puts. So, that's one of the differences I found between what we do and what he does. And, for me, just being able to, taking off at maybe 90% profit is a valid approach for what we do.
Yeah, I agree. I find the sweet Bobby trade is the 111 or the 112. It's absolutely ideal for anybody that's nervous about taking profits, because you don't get day-to-day huge swings. So it's a little easier to manage these, I find.
Mm-hmm.
And then I've been trying to get into day trading, zero DTEs, and Tastyworks are doing a little bit on it now. They've realized that a lot of people are doing it, and that there it becomes a lot more difficult. So it really depends on the strategies that you employ. But I'm trying to sort of get a playbook together of strategies that I want to use and I'm comfortable with. So I'm just playing around with a few things, but the book helped me in that way.
Yeah, I don't trade the zero DTE stuff yet.
Yeah.
I know myself well enough to know that I do like some action. And I would think that his way of trading in this whole book would apply very well to that type of trading.
Yeah, absolutely, for sure.
Oh, what else you guys have? I can tell you one of the things that I found interesting was his whole deal on how, which I think applies to us, and how he trains his brain. He talked quite a bit about brain training. And I thought a lot of his stuff was interesting. Like he had this whole chapter on using disgust to help train the brain. And, some of that was kind of hard to read, but for me anyway. But what y'all think of that?
Yeah, I found that particularly hard, to be honest. It's like everybody, I don't know about anyone else, but you're sitting here on your own, watching things happening, watching the screen, and when I get it wrong, then yeah, you get the feelings of, oh my God, what are you doing? What do you think you're doing? You're totally wrong. And then you get 2 or 3 in a row totally wrong, and then it really sets in. But I don't get disgusted. I get really disappointed and a bit mad, I suppose. And I know that all the books, Trading in the Zone and all, tell you don't get mad, get even, but it's really hard not to get mad. It's just a human trait that you get disappointed and angry with yourself for making mistakes. So it is really all about having a good mindset, but it's very hard to get into that good mindset all the time.
Yeah, I think that was one of the key pieces of the book, is the kind of the non-emotional mindset, where you can just take losses and gains with equanimity and still continue just to receive the information the market's giving us and make good decisions.
Yeah, and it's all good in hindsight, and you think, when you look back on it and you think, so what did I do wrong, and how did it go wrong? With the benefit of a whole day's price action, you can see the signals, but it's in the moment, they're a lot harder to interpret, for me anyway.
Yeah, I think it's hard for everybody.
Yeah.
What else do y'all like about it? or not like about it?
Good morning, everybody. Staying in that train of thought, what really stood out to me is remembering that the market is just numbers. It's just the price, and the market's not out to get me, and it's not trying to make me lose money. The market basically is neutral. It has no emotion. So in order to trade with the market, I have to have no emotion as well. I admit that I have not finished the book yet. I'm about 3/4 of the way through, but I really loved it. For me, the part about moving away from pain and the part about the fear of losing is what really hit home for me, because I'm trading two of the accounts that I'm trading are my husband's retirement accounts. One's a traditional IRA and one's a Roth IRA. And of course, I have fear and worry when things start to go against me because of him, because of my husband. Like, I don't, these are his accounts, and I think it just adds a layer of anxiousness about it.
Oh, I totally get that. That just makes the difficulty of the dive that much more difficult. Yeah, I thought he, it was one of the first books I'd ever read where he actually kind of lays out his process for how he prepares for the day, how he prepares to, remove his emotions from it, how he challenges himself with, to make sure his learning is good. I mean, it was, to me, a pretty inspiring book in that way as well.
I like the part where he showed, I don't know how, if he did it handwritten or exactly how he did it, but when he showed those charts of where his entries and exits were, and then he used those charts the next day to prepare himself to look at, here was a day where I made 10 mistakes, and look at the mistakes. I thought that was super helpful of actually seeing it on a chart. And then it becomes very clear, why in the world did you take that short, or why, I thought that was great. That was a really helpful exercise.
Yeah, I thought so too. I thought that was a great exemplar of how he kind of trains his brain to change, to do, so he doesn't make the same mistakes over and over again. I like that part a lot too. So, one of the other things he talks about is, is kind of one of the definitive, he says one of the definitive things for his type of trading is adding to winners. Do we have an equivalent to that in the option trading world? What would be our equivalent to adding to winners? Any ideas there?
I guess one thing that we could say is, like, our trades are winning a lot oftentimes when theta comes in. So our theta is low, and adding to a winner would be adding additional trades to boost up our theta. That's about the only thing I could think of.
Yeah, I think that makes total sense to me. I think that's right. Because we have to keep gas in the tank.
That concept is a little bit hard for me. I'll be honest. I've got to rethink how I think about the market. I'm constantly thinking it can't go higher or it can't go lower. And I really need to work on that.
Yeah, that's one of my big challenges too. I want to take, I want to take my profits off the table. I continually want to do that. I have to resist
Me
that.
too, for sure. Me too.
I guess in a way, Bobby's right. We're constantly adding to winners in the way that we manage the trading that we do through the 111 and 112, because we're rolling, closing, opening new positions, and sort of we're on a roll. It's, I won't say constant winning, because you know they don't all win, but in general, we're all doing it if we're managing the strategy. I think it's going to be a different mindset if you're in a day trade, say, because you don't really get opportunity to add to winners unless, you know, the market is on a tear, and then it's easy. You know, you can just jump on the trend and keep going. So there's two different sides to this, and I think adding to winners is the most difficult part, because you're so happy to see that you've got a winner and it's going well. You don't want to jeopardize it by jumping on and then, you know, suddenly you don't have a winner.
I think that's a good point, Bill.
Thanks. Yeah. Good discussion so far. Come on, everybody, join in. Don't be shy.
Yeah, Evan, you got to have something else you think about this book.
I don't want to monopolize the conversation, but
Don't worry about that.
like I said, the part about you know, like when you're in a trade, you still and it's losing, you still have hope, and closing that losing trade then solidifies that you have a loss, and you don't want the pain of that loss, and so that's why we don't close losers. That really stuck with me, because isn't that so true? Like you're still hopeful. And we all know that hope is not a trading strategy, and that really stuck with me. I thought that was really good.
Yeah, I
So
agree.
on that, I think we talk about it's hard to close a losing trade, or it's close to it's hard to rebalance when the market could rebound the next day. But until you get into a position where you really are rolling and holding on, I don't think most people realize that holding on almost feels worse, or at least it did to me. So a couple of years ago, I was in a different trading room, and we focused on basically rolling your way out of anything. That was kind of the premise of this whole group. And at one point in time, I had rolled a position 4 or 5 times, and the paper loss, unrealized loss, whatever you want to call it, was something like 1/6, or about 15% of my portfolio.
Oh, wow.
And waking up every day, looking at that thing, hoping it went in your favor instead of against you, felt way worse than it would have to just take the 1 or 2% loss initially. And I think that's one of those things that a lot of people kind of have to do and live through. And if you do it enough, I think you'll realize it almost hurts more to not take the loss. And maybe that's just my mindset, but from my experience with it, I think there is a lot of value in just taking the loss, moving on, and rebuilding. And I think that we kind of see the opposite side of that with our recent 111 positions last month. You know, Bobby was talking the other day about how, we could have just held on and we would have been fine. And, you know, he took the loss and is now saying, you know, maybe I shouldn't have taken it. But I don't know, I'd still argue that was probably the right choice. And, you know, yes, we're a little bit worse off for it, but it could have got way worse if we just held on. So
yeah, I tend to agree with that also, Evan, because, you know, I know that there's a really good Tasty Work segment where they talk about the equivalence of a stop loss to a hedge. And I think that there's some mathematics that where, you know, taking a stop loss is similar to doing a hedge. But like when you know, I know Ryan's doing a bunch of work on the COVID crash, and man, that thing's hard to roll on. I mean, you kind of run out of rolls, I think. So, I mean, to protect ourselves, I think we have to be, I think that taking a loss is, at some point, we've all got to have our uncle point, our ouch point, where we go, yeah, I just didn't pull the ripcord and close this thing down and then fight another day.
With that being said, the point at which we pull the ripcord, or our uncle point, cannot be when we run out of buying power. If you get to that point where it's like, I've rolled, I'm out of buying power, I can't do anything else, okay, I'll pull the ripcord. I feel like we haven't really planned it out well enough, because at that point, if you've used everything, you've pulled out all the stops, you're probably in a really big hole. So you almost have to be able to roll indefinitely, like Tom Sosnoff, right? It's like the only way you can really get away with this idea of infinitely rolling is if you truly have the capital and you're trading small enough to infinitely roll. And that looks different for everybody, but
yeah, but
our ripcord can't be, oh, we're out of buying power, there's nothing else I can do, I guess I'll take the loss, because at that point you're buried.
yeah, I mean, even Bobby pulled out an old trading plan the other day that had a ripcord in it. I think it was down 5% in one day. He had permission to just close his positions, just pause.
Yeah, we talked about that in one of the, I think it was one of the daily meetings for YouTube, and Ed and I were talking, and I kind of had a similar plan at 7%. If we have a circuit, we hit a circuit breaker down, I have permission to just close everything and take whatever loss I have and not deal with what's going to come in the future.
This is Candy, and one of the things that resonated with me when I heard about Karen the super trader early on, when she first came out and told her story, was everything for her was just the math. And it wasn't emotion, it wasn't looking, you know, necessarily at analyzing charts, it was the math. And we're in risk-defined strategies where they're fixed. The return on them are fixed. And we need to maintain a win-loss structure that allows us to have profits. And if we continue to not have hard and fast financial gains and losses, it's really easy to get sucked in to say, the chart looks like it might bounce here. You know, we want to inject that hope to bridge the gap on the pain. And it really needs to be about the math, because it is about the money. Just like Stacy said in the beginning, it's about numbers. And we can try to make it sound sexy and hedge and add all this complication to it, but in essence, the math has to hold together at the end, and you need to maintain your capital and you need to protect your profits. And anything that we do and stray away from the reality of that, we're just putting our capital at risk.
That's really well said, Candy. Thanks, because I think you just did a great summary of what the mindset of a successful option trader needs to be. What else you guys got?
Yeah, I just want to say that, you know, talking about what Ryan's doing and the kill switch, it looks as though during the COVID crash, and he's testing a lot of different things, but it looks like a kill switch would have been probably the best thing, right? At some point to go, I need to get out rather than sit there and endure the pain. And that is so tough to go admit that, especially as Evan said, with me during March, looking back now, yeah, I say we just should have sat through it, but we didn't know that at the time.
Right.
And I kind of agree. At the time, it was the best thing for me to do to get out of the trade, because if it had kept going against me and volatility kept going up, then it could have really damaged my account. So, yeah.
Yeah, back in March, I hit a knuckle point and probably closed down a lot of things at just the wrong time, that if I would have rode through, I would have been better off. But I didn't have it well thought out in my rule set. I closed it down because I just was afraid of taking any more. I didn't have a rule for how I re-entered, because I can see now that if I would have, you know, even though I exited, if I would have re-entered with strength and had rule set for that, I would have been fine as well. You know, it's just taken me a little time. I finally got back up to, you know, flat, but it's taken me a little while to, a longer time to do that than I think it would have been if I would have had a different rule set.
What I try to do is make it very non-emotional. I use a market structure approach so that I have a feel for the trend of the market. And if I'm staying on the right side of it or not, because I traded live through COVID, and I know how when the market hits a certain VIX level that it loses its market structure, and it will bang you on the upside and it will bang you on the downside. And that's when your capital is at the greatest risk. So I use a VIX parameter that says when the VIX is starting to go over 30, you're starting to lose your market structure. And market structure is something that is an important leg on my stool, where I don't have to guess, you know, should I be trading this market? Should I be trying to, you know, take profits? Should I be adding more capital to an unstable market? No, I use my guidelines and my market structure to tell me when my capital is at greatest risk, or when I can go ahead and start to resume my capital allocation and be rewarded for it without just, you know, putting it in. And because the COVID situation of trading through it left, you know, certain opportunities that I put rules into place from that event. And I try to stay on the right side of the market and take advantage of the higher implied volatility. But I know that I have nothing to trade when it starts to become extremely irrational and emotional. And I can't use a trade structure like a futures to save me, because it's a one-dimensional trade. It's only directional. And at that point, volatility is what's swinging. And I don't necessarily have a tool for that when I'm just trading directionally. So I've tried to employ rules and structures that have helped keep me on the right side after that. Know when I can, you know, expand my capital and when I need to be kind of, you know, slowing down. And I combine those two with my wonderful Sweet Bobby spreadsheet. You know, I combine the two together so that I have a multi-leg stool.
Yeah, that's awesome. Folks, so let me just, you know, ask a general question about this book club. Do y'all want to keep doing this? I've got an idea for the next book, and Bobby's got an idea for the book after that. Do y'all have ideas for books y'all want to see? I was thinking the next book we might do is one of the, I don't know if one of the Market Wizard books, because I'd like everybody to read the Ed Sakota chapter. Ed's a friend of mine, and he's agreed to show up and answer questions. I told him he didn't have to do a presentation or anything, but if that would be interesting to people, we would do that. Bobby's suggested we look at the man who solved Wall Street, the story of Jim Simmons and or Simonson, Renaissance Capital, which is a quantitative guys that took a quantitative approach to trading. Do y'all have other books y'all would like to see covered, or, any other ideas on how to improve this whole process?
Yeah, I think most trading books, some of the old stuff. I mean, I'm currently reading A Random Walk Down Wall Street, and
Well, I love that one.
that's really interesting. But there are others. There's another one that I'm sort of reading. It's called Against the Gods, and it's nothing to do with religion. It's all about the story of risk, how risk came about, and that's really an interesting book. But it might not be for everybody in sort of like a trading book discussion.
No, I like that, both those ideas, Bill. Those are cool books. Against the Gods is kind of the story of risk and insurance and that kind of thing, right?
Yeah, exactly.
Yeah,
I don't know if anyone else has read it or even heard of it, but
good.
I've sort of about halfway through it, and yeah, it's very interesting and a worthwhile read, I think, just for sort of a backstory.
Yeah, I mean, does anybody else have like a favorite trading book they would like to see, exposed to everybody?
There are so many, Trey. I mean, but everybody's got a different favorite.
Yeah, I'm hoping so.
Feel like Lacello's How to Make $1 Million in the Stock Market Automatically. I built a spreadsheet for that, but for the AIM strategy, automatic investment management, and that might be one we could revisit.
I haven't heard of that one, so I'd be interested in that one for sure. Well, if nobody has anything else, we can let this thing go.
One other one, Trey, I
Okay.
would recommend. It's a lot along the same lines of the book we're reviewing today, but what I learned from losing $1 million in the market.
Okay.
It's a little bit of a dry read after reading the book we're reviewing, but it's definitely for anybody that has difficulty managing risk. It's a good book.
Okay, excellent. That sounds, that really is our main job, is being risk managers in this thing, because Bobby's got us set up with I think a great approach that if we keep doing it, we're going to make money. We're going to keep putting fuel in the tank and driving the car well, and we'll make money as long as we manage our risk appropriately.
Yeah, I think the Tom Hugard book from today is probably the best one you could have picked to start with. And really, my last point is the clues in the title. The best loser wins. That's what he says sets him apart. He's not a better trader than anyone else. He doesn't get any insights and things like that. He just can stand losing 30% of his trades and winning 70, losing 13. Yeah, in no other industry can that sort of success rate be sustained. Yeah, if let's say he makes the analogy of a dentist or a doctor being successful 60% of the time, well, they'd be out of business. But as a trader, you can keep going and keep coming back, and that's what I take out of it. And so, like I said, perfect choice for me for the first one.
Cool, thanks, Phil.
Yeah.
Well, anybody else have any concluding remarks they want to offer up?
Hey, what is the Jesse Livermore book? What is it? Reminiscence of a Stock Operator or something?
Yeah, Reminiscence of a Stock Operator. That's a great one.
Yeah, that might be a good one too.
Well, and Tom Houghton has on his book in his resource page, an abridged version of Phantom of the Pits. I don't know if anybody's ever looked at that, but his abridged version, where he has kind of some notes and stuff in it, I think is a really good and a short read. A really good one also. All right, folks. Well, I appreciate y'all showing. We'll try this again sometime, and any ideas, just post them in the room or message me or Bobby, and we'll see how this thing develops out.
Yeah, thanks, Trey. Good job.
Yep. Thank you, Trey. Good job.
Well,
Great
thank y'all.
kickoff. Great start.
Take care.